Listen up. When you think about sports, when you think about greatness, when you think about a brand that has completely dominated the global stage for decades, you think of one name, Nike. This isn't just some company that sells sneakers, it's a cultural phenomenon, a titan of industry with that iconic swoosh logo recognized in every corner of the world. For years, this company has been the undisputed champion, a growth stock that seemed unstoppable. Its legacy is built on legendary athletes like Michael Jordan, Tiger Woods, and Serena Williams, who didn't just wear the products, they embodied the brand's core message of victory and perseverance. You bought Nike because you were buying a piece of that winning spirit. It's a masterclass in marketing, folks, an absolute powerhouse. So how did this giant make its money? It's simple, but brilliant. The primary engine has always been footwear. We're talking about everything from the legendary Air Jordans that people line up for, to the high-performance running shoes that marathoners swear by. But it doesn't stop at your feet. Nike's apparel division is a beast in its own right, selling everything from dry-fit shirts and athletic shorts to hoodies and team jerseys for the NFL and NBA. They built an empire by catering to everyone, from the professional athlete to the person just looking for comfortable, stylish athleisure wear. This two-pronged attack on the market was a recipe for massive, consistent profits for a very long time. Then, Nike decided to change the game with its direct-to-consumer or DTC strategy. They wanted to own the customer relationship, cutting out the middlemen like department stores and smaller shoe retailers. They poured billions into their website, Nike.com, and their SNKR's app, creating a digital marketplace where they controlled the entire experience, from the marketing message to the final sale. This move was hailed as genius. It meant higher profit margins and a direct line to their most loyal fans. For a while, it worked like a charm, supercharging their growth and making them seem even more invincible in the retail landscape. It was a bold move from a company that's never been afraid to take a risk. This strategy cemented Nike's position not just as a manufacturer, but as a premier global retailer. The company's massive scale, its incredible brand recognition, and its sponsorships with the biggest sports leagues on the planet created a formidable fortress. Investors loved it, and the stock price reflected that confidence, climbing to dizzying heights. It seemed like the "Just Do It" slogan wasn't just for athletes, it was the company's own business mantra. They were a blue-chip stock, a buy and hold for anyone's portfolio, and the undisputed king of the consumer discretionary sector. For years, betting against Nike was a fool's errand. But as we've seen, even the mightiest titans can stumble. So what happened? How did this unstoppable force suddenly hit a wall? The first major sign of trouble came from within its own strategy. That big push into direct-to-consumer sales, which once looked so brilliant, started to backfire. As it turns out, cutting ties with major wholesale partners like Macy's and Foot Locker in 2021 was a mistake. They alienated some of their most important distribution channels and made it harder for everyday shoppers to find their products. While the digital-first approach sounded good in a boardroom, it ignored the reality of how millions of people still shop. This created a huge gap in their sales, a self-inflicted wound that competitors were more than happy to exploit. On top of that, the company got slammed by a perfect storm of operational nightmares. First, the supply chain disruptions that started during the pandemic lingered far longer than anyone expected. Factories were shut down, shipping costs went through the roof, and getting products from Asia to North America and Europe became a logistical mess. This led to a huge inventory problem. At one point they had too little, then they had way too much. To clear out all the excess sneakers and apparel piling up in warehouses, Nike had to resort to heavy-duty discounting. Slashing prices like that is a killer for profit margins, and Wall Street hates seeing margins shrink. Then came the innovation issue. Let's be honest, where are the hot new Nike products? For a company that built its name on groundbreaking design and must-have styles, the creative pipeline seems to have run dry. Consumers, especially the younger generation, are always looking for the next big thing, and lately, Nike hasn't been delivering it. The classic styles are great, but you can't build future growth on past glory alone. This lack of fresh, exciting products has led to a decline in brand heat. When your core audience starts looking elsewhere for what's cool, you have a serious problem on your hands. It's a red flag, people, a big one. All of these issues came to a head in their financial reports, and the numbers don't lie. Look at the earnings calls from 2024. We saw revenue declining across the board in every single geographic region, including their key markets of North America and China. Fiscal Quarter 1 2025 revenue fell a staggering 10%, and digital sales, the very thing they bet the farm on, dropped 20%. The company had to issue a weak sales forecast for the rest of the year, which sent the stock plummeting. When a giant like Nike tells investors that sales are going to drop by double digits, it sends shockwaves through the market. The fortress was showing deep cracks. While Nike was fumbling the ball, its competitors were suiting up and getting ready to play hard. This isn't the same market it was 10 years ago. The biggest comeback story is Adidas. Remember them? They were left for dead, but they came roaring back with a brilliant strategy focused on retro styles like the Samba and Gazelle. Their stock was soaring in 2024 while Nike's was in the gutter. But it's not just Adidas. You've got newer, nimbler players like Hoka and On Running who are absolutely dominating the specialized running shoe market, a category Nike used to own. These brands are connecting with consumers and stealing market share piece by piece. The competitive landscape has fundamentally changed. It's no longer a one-horse race. Brands like Lululemon, once just a yoga pants company, have successfully expanded into footwear and men's apparel, creating a loyal following of high-income consumers. Under Armour is still fighting for its piece of the pie. This increased saturation means Nike has to fight harder for every single dollar. Consumers now have more choices than ever before, and they are not automatically defaulting to the swoosh. The days of Nike being the only premium option on the shelf are over. This isn't a temporary problem, it's a permanent shift in the athletic apparel universe. Compounding all this is the tough economic environment we're in. When inflation is high and people are worried about their jobs, what's the first thing they cut back on? Discretionary spending. A $150 pair of sneakers is a luxury, not a necessity. Consumers have become much more selective and value-conscious. They are thinking twice before splurging on premium products, and that directly hurts Nike's bottom line. The macroeconomic headwinds are strong, from higher interest rates making business more expensive to currency fluctuations that eat into profits from international sales. You can't fight the Fed, and you can't fight a cautious consumer. This perfect storm of fierce competition and a weak economy has put Nike in a defensive crouch for the first time in a long time. The company's pricing power, its ability to charge a premium, has been severely eroded. They are stuck between a rock and a hard place. They need to innovate to justify their prices, but they also need to offer discounts to move inventory and compete with more affordable options. This pressure from all sides is what has caused the stock to underperform the broader market for 3 consecutive years. The market is telling you that Nike's old playbook is no longer working in this new, more challenging arena. So, is it game over for Nike? No, don't count them out just yet. This is a company with immense resources, a globally recognized brand, and a history of pulling off incredible comebacks. Management knows they're in trouble, and they've already started to make changes. They've called fiscal year 2025 a transitional year, which is Wall Street code for, we know we messed up and we're fixing it. The first step is getting back to what made them famous: product innovation. They are pouring money back into research and development to create the next generation of must-have shoes and apparel that will get people excited about the brand again. A key part of the turnaround strategy involves fixing their sales channels. Nike is starting to unwind its disastrous move away from wholesale partners. They are mending fences with retailers to get their products back on more shelves, making them more accessible to a wider range of customers. At the same time, they're not abandoning their digital efforts but are refining them to work in harmony with their physical retail presence. The goal is a balanced, multi-channel approach that meets customers wherever they are. It's a smarter, more realistic strategy that acknowledges you can't force everyone to shop the same way. This is a critical pivot. To win back the hearts and minds of consumers, Nike is also ramping up its marketing spend. Even with falling sales, they are increasing their demand creation budget to make sure the swoosh is front and center during major global sporting events like the Olympics. They need to remind the world why Nike is synonymous with athletic achievement. This includes investing in new athlete endorsements and telling powerful stories that resonate with today's culture. Brand relevance is everything in this business, and Nike is opening up its wallet to protect its most valuable asset. They have to spend money to make money. Ultimately, Nike's recovery depends on execution. Can the new leadership successfully revitalize the innovation pipeline? Can they strike the right balance between direct sales and wholesale partnerships? Can they adapt to the new competitive and economic reality? I think they can. The company's incredible scale, its deep-rooted connections in the sports world, and its powerful brand give it a fighting chance. The stock has been beaten down, trading at a 5-year low price-to-earnings ratio at one point, which suggests the bad news might already be priced in. If Nike can deliver on its comeback plan and start posting some wins, this could be a major buying opportunity. It won't be easy, but I'm not betting against the swoosh just yet. Booyah.